Hi, my name is Nicholas Kyung, and today I'm going to be representing Ace Capital Management, and we're going to be discussing the rationale, the strategies, as well as the insights that we gained from our success. In the past 3 months, we turned an initial investment of $100,000 to $272,000, which is 161% above the S&P 500. Now, let's dive a little deeper to how we achieved our success. First, we maintained three key goals throughout the entire competition. Our first goal was to secure consistent returns through stable stocks, mutual funds, and bonds. Secondly, we wanted to acquire significant yields through short selling as well as momentum-based trading. And lastly, we want to maintain diversification across all sectors and assets. Moreover, we implemented a three-phase approach, with our first phase being high-risk tolerance, phase 2 being controlled expansion, and phase 3 being wealth preservation. Let's go more in depth into phase 1. In phase 1, where we started off with $100,000 of initial investment, we knew that our capital was inherently lower. And because of this, we were able to take on more risks and still have a less loss of money. And the reason we wanted to take a more aggressive approach in the beginning is in order to be able to take into account the principle of compounding. And as we took advantage of this, we're able to reinvest our profits into the future into more stable assets and more consistent assets for the future, while still also maintaining a similar amount of profit. One of our key trades was ARQQ, which we entered a short position after hearing of a reverse 25-to-1 stock split. And essentially these reverse stock splits show weakness in terms of cash flow within the company. And so we estimated that there would be a decrease in overall investor sentiment due to this news. And we were correct. And after making entering the short position, we were able to make a profit of around $41,000. Next, we have Bold, which we entered a short position after hearing news on them potentially joining a healthcare conference. And after this news came up, investors completely started having high volume into this company. And this price skyrocketed, going up 30% in one day. And while we believe that Bold joining the healthcare conference would be good for the company overall, it didn't have a lot of inherent conditions of value for the company. And so we believed that after the hype wore off, there would be a reversal back to its initial price. And we were correct. And after making the short position and the price dropping, we were able to make a profit of around $23,000. And lastly, we have TCS, which we entered a short position after hearing news on potential delisting, as well as them enacting a poison pill. And what a poison pill essentially is when a company tries to decrease their monetary assets in order to de-incentivize investing companies from, investing in the company. And while TCS was successful in enacting the poison pill, ultimately they had to decrease their overall monetary assets. And because of that, the investor sentiment obviously decreased. And so the value of the price also decreased. And through that, we were able to make a profit of around $10,000. Let's move on to phase 2, which is controlled expansion. And this is where we kind of scaled up our winning strategies with larger and more calculated trades. We also tightened our research filters and diversified across more sectors, and we chose a slightly lower volatility assets. One of our key trades is DIS, or Disney, which we entered a long position after hearing potential news on development of new rides within Disney World. Moreover, we heard that there would be an earnings report coming up in the next few days. And so our team did analysis based off of quantitative and qualitative measures, looking through cash flow statements and income statements in order to calculate the earnings per share for the next quarterly report. And we found that the earnings per share was above current market sentiment. And so when the earnings report was released, we were correct. And the earnings per share was above what was currently expected of the company. And so the stock price jumped in price, and we were able to make a profit of around $11,000. And we considered a similar process for CVS. After looking through the statements as well as the cash flow, we kind of calculated that it would be above investor sentiment again. And we were correct again with a profit of around $8,000 off of that trade. Now that we made a lot of money off of phase 1 and phase 2, we wanted to kind of slow down a bit and focus more on preserving our capital as we were ahead of the game. So we moved on to phase 3, which is wealth preservation. And this is where we kind of shifted more into defensive assets that had lower volatility. We added more bonds, ETFs, and equities that just had more value in terms of their long-term balances. And two of the assets that perfectly met this match was BRKB, or Berkshire Hathaway Class B, and VFIAX, which is Vanguard. And these two ETFs inherently invest themselves into a lot of different other companies, which means they have a lot of diversification value and conservational value in themselves. And we also invested in the Treasury bond, which, although has the lowest interest rates on the market, also has the lowest volatility on the market, meaning that it perfectly met our key goals for wealth preservation in phase 3. However, trading is not just about the profits. It's about how you gain the information and analysis in order to make proper decision making prior to the trades. And you don't have to be Warren Buffett to know that investing in a company you have no idea about is just plain stupid. So what did we do? This kind of brings us to our mantra, which is the ACE strategy. And this stands for 1, assess, 2, calibrate, and lastly, 3, execute. Let's go more in depth to each section. First, we have assess, where we screen for and evaluate the opportunities on the market. We conducted a screening through TradingView, which is one of our filters, and we were able to filter through and look for high momentum indicators. And such indicators would be like pre-market percent change, pre-market volume, as well as the market cap and the volatility of the asset. And through this, we were able to create a long list of high potential assets that were had strong momentum and high volume, which means a lot of investors were looking at these stocks. And this strategy allowed us to emphasize finding more unusual activity or early reversals in the market, and this allowed to make easier predictions of how the value would move in the future. And then this brings us to calibrate, where we look through the stock list that we found from Assess and filtered for more quality trades. We narrowed down our list by looking at quantitative and qualitative measures of these companies, looking through recent news or news reports, as well as financial statements to see what kind of financial position and an overall position that this company is at the moment. And through this, we also reviewed sector strengths as well as market sentiment. And these are some really important points for the diversificated value and how it would contribute to how diversified our portfolio was. And we'll go more into that in just a bit. And lastly, through this, we only retained trades that match with our risk tolerance and goals for those specific sectors. And this brings us to E, where we try to execute trades with strategic entries as well as strategic trade and risk management. We timed our entries based off of volume, which means that there's a lot of investors looking at these stocks. And that, again, makes it easier to predict how the price is going to be moving. If it's heavily bullish or heavily bearish, it's really easy to tell that for a long time, it's probably likely going to stay in those directions. And moreover, we also applied position sizing and correlation checks to manage risk. And this allows us to mathematically find what is the ideal risk-adjusted return that we can find for these individual assets within our portfolio. And again, I'll go a little more into these math stuff later and see how that contributed to the diversificated value of our portfolio overall. And next, we executed both short and long positions based off of the phase strategy. So if our phase is looking for more riskier, higher volatility stocks, this is where we would try to evaluate that and see if that met our match. And lastly, we prioritize trades that reinforce our overall portfolio structure. And this is the pre-trade diversificated strategy that we implemented prior to each trade. So first we would calculate the beta, or the volatility of every single asset. And this allows us to see if it would match the key goals that we would have for that phase. For example, if we're looking for, and we're currently in phase 3 where we're trying to focus on capital preservation, we mostly want to focus on low volatility or low beta assets, as those would match our goals. Next, we want to perform correlation analysis. And this is where we look at the asset that we're trying to invest in and see how much it moves in tandem with other assets within our current portfolio. And the correlation analysis generally comes out to either between -1 to 1. And that shows how correlated it is with another asset. And we believe that if it was above 0.85, we consider that highly correlated. And so we would want to remove those from our potential list of investments. And next, we allocated based off of risks. So after finding what stock we want to invest in, what is mathematically the best way to invest in it? Well, this position sizing formula says that K over beta, or the risk tolerance multiplied by the portfolio value over the overall volatility asset, is the most mathematically best way to invest in a company in a risk-adjusted fashion. And lastly, we calculated our portfolio beta with the implementation of the new asset, just to do a quick check to see if that was in a good spot. Let's utilize BRKB, an investment in phase 3, to make this more clear for you. So first, we looked at the past 90 days of historical data for BRKB in order to calculate the volatility or the beta of the asset. And we found it to be 0.89, which is 0.11 under the market average, which means that it's quite safe. And so since we invested into it in phase 3, which we focus on capital preservation, this was perfect. And next we did correlation analysis with other assets that were in our portfolio at the time, like Disney, Vanguard, and the treasury bonds. And none of them were above 0.85 in terms of correlation. And so we believe that this would provide a great diversificated value to our overall portfolio. And lastly, next we did a quick position sizing check to see what would be the best amount of capital that we should invest into BRKB. And we found it to be around $61,000, which we did invest that amount into the BRKB. And lastly, we just did a quick portfolio check, beta check of our overall volatility of the portfolio. And we found it to be 0.84 after the investment of BRKB, which is in a very good spot. So, was our strategy effective? Well, I believe our strategy was very effective for many reasons, but mainly because of our three-phase portfolio. This three-phase strategy allowed us to become very adaptable throughout all parts of the simulation, as we were able to leverage volatility in the short term to find a lot of those short-term gains, as well as be able to be very conservative for our long-term gains and have a lot of consistency in that area. And our data shows, as we did turn $100,000 to $272,000 in 3 months. And our Sharpe ratio, which generally calculates for a portfolio's risk-adjusted return rate, was 3.10, which is considered excellent by industry standards. But how could we improve this to implement it for the future? Well, first we would like to implement smaller and smarter position sizing. Next, we would like to decrease our dependency on short selling and increase our dependency on ETFs, bonds, and dividend stocks. Next, we want to implement more patience within our strategy, because while we were profitable in most of our trades, we ultimately left a lot of money on the table, as a lot of times once we saw the profit, we saw the green, we decided to kind of get out of not stick to our analysis and just exit the trade and get those profits early, which left a lot of money on the table, for example, with PGHL. And lastly is the implementation of automated tools, as we would be able to use those in a real-world environment. We would like to implement stop losses, trend analysis, and portfolio optimization just to further optimize our strategy overall. And thank you for listening to my presentation. And just as a recap, Ace Capital Management was able to achieve a well-diversified, well-researched, and disciplined portfolio in these past 3 months. And we learned a lot of insights through our success. And trading, remember, is not just about the profits, it's about the method. Thank you for listening. Do you have any questions?